Ladies and gentlemen, Paramount Global has popped a bit today, and even still, I still believe it is relatively undervalued in today's world. However, they had a disappointing fiscal year 2022. They had disappointing Q1 2023. There is speculation abound that maybe Buffett and Berkshire are regretting their position that they had purchased in Paramount. When you look at the financials, you can see while revenue has steadily gone upward, gross profit not so much. We haven't broken 11 billion since 2018, even though revenue has been going up, which is, somewhat concerning for the future financially of this company and for the bottom line if you're a shareholder. Now, when you look at the bottom line, you can see that the company has produced pretty solid free cash flow and EPS based on current prices historically, although there's been a disconnect between the two and it's flip-flopped which one's higher, which one's lower. Recently, this has really kind of come to a head, all right? In 2021, you saw this massive EPS of $7 per share, which probably made their PE look like ridiculously good, with a free cash flow of only 93 cents per share, and then a massive fall off in EPS to $1.61, and then negative free cash flow in fiscal 2022. And it seems like more of the same of these 2022 kind of piss poor results in Q1 2023. So that would be why they had to cut the dividend, all right? And they've announced that they're closing some kind of underperforming business units, reducing some headcounts. Probably smart things to do because a lot of their costs have kind of ballooned. That's why with revenue going up, GP hasn't gone anywhere, right? And the bottom line even worse off, right? Their cost of revenue has gone up. Their selling, general, and admin costs have gone up, etc., which that just squeezes that bottom line in terms of EPS and free cash flow if you're a shareholder, which you don't want. You don't want that because then it doesn't leave them anything to distribute to you at the end. Now, that being said, people say, hey, with some of the inconsistency here, this stock is pretty hard to model, right? Because it's up and down and up and down and up and down. Okay, we will get to that. But first, I just want to point out we just had the 13F filing from Berkshire, which is required for any fund manager with over $100 million under management. They have to show what they bought, what they sold, and what they currently hold. They kept what they had in Paramount and even added about 0.1% to their position. So we're not... looks like we're not selling, at least yet. Anything can happen between now and the next 13F, and their average buy price on Paramount is in fact $31.64. So my 100 shares I have was acquired at about $16.50. So my cost per share is about half of what Berkshire's is at the moment. So I'm pretty happy with that, especially if they've stayed in. It means that, hey, if they are going to see a return at that $31 share price average, I wonder what kind of return I'm going to get at $16.50 as my current average. So I'm pretty excited about the fact that they stayed in. It must mean that whatever value they saw last year or whenever it was exactly they started purchasing, they must still at least somewhat see it, or maybe giving it a little bit more time to play out. And I think, when you start plugging into the models, you can maybe see where they see the value. Because here you go. Now, their EPS as a starting point, I put in $3, okay? And the reason is because when you look at their free cash flow and their earnings, you can see many times where they were close to or where they soundly beat that $3 number, right, in the last several years. And only in the last couple has it been a little dubious on that $3 number, with the disconnect widening between earnings and cash flow pretty badly here in 2021 and 2022. But before that, what you might call a more normalized kind of number for them does seem to be maybe from the threes up to maybe the 5 and change type numbers for earnings and cash flow per share. So I'm kind of splitting the difference. I mean, 3 might even be kind of low, honestly. I'm not trying to, highball the company by any means. I'm a value investor. I want to get an outsized return. But anyways, I put in $3 as our starting point with zero growth. Okay? Zero growth. Giving them credit for their tangible book value of $4 per share, since those are assets they already have that are tangible. Now, granted, if you actually looked at their regular book value, not just their tangible book value, and you gave them some credit for their goodwill and intangibles, this number is actually a lot higher. They actually have like double their market cap in terms of shareholder equity if you count goodwill and intangibles. However, value investors generally only look at tangible because that's what typically you feel that you could liquidate if it came down to it. So zero growth, $3 EPS every year for the next 20 years, which some could be higher, some could be lower. As long as they just average that, this would be about right. 15% discount rate. So basically, with these like absolutely garbage numbers that assume that they can't really take the business anywhere past where it's been. Actually, I mean, kind of even lower than where it's been, because they've beaten this $3 number a lot of times over the last few years. You could pay up to $22.85 and get at least a 15% return if they average $3 EPS with zero growth. And I think that's probably why the Berkshire boys are still in, right? Because if you drop this down to a market discount rate of 10%, suddenly it's worth pretty darn close to their cost basis with zero growth. And hey, if you assume even the smallest slight amount of growth in EPS average from this number, suddenly you're basically right at their cost basis. So I definitely, there's an argument to be made, I mean, that Berkshire was getting a screaming deal, even if they were assuming some really, really, really low growth numbers. And I don't know what they would have modeled as their starting point. They might have a completely different way of reaching value targets for their stocks compared to what I do. But I can definitely see where Berkshire thought this was a good value when they got in. And personally, I'm happy to pay half what they pay, all right? And, I think it's jumped today partly because the news came out that Berkshire hasn't sold any of their shares. In fact, they added a small amount. But hey, do you own any shares of Paramount Global? Let me know in the comments below. Give me a subscribe if you'd like to keep up with the stocks that I follow and with the channel in general. Join the conversation on an ongoing basis. I love to hear from you guys and have these spirited discussions. Also, Discord is an option if you want to have more real-time spirited discussions. I like to spend a good amount of time in there every single day talking to my subscribers and friends. So I will leave a link to that in the description below. Take it easy, everyone. Have a wonderful afternoon. Cheers.